I believe we can proceed now. If you can see my screen, you let me know. Are we okay? If you can see my screen, you let me know. Is that okay? All right. Is my screen visible? Is my screen visible, please?
No,
Is it
not
visible?
yet.
Is it visible now?
Yes.
Okay, that's fine. Good. Okay, so we will be dealing with this question. After that, I would share the question. All right. So we would go through the question quickly. So I need someone to read for us as we go along. Who is reading for us? Who is reading for us? The time is limited though, so we need to speed up. It's already 4:30.
Please, I'll read for you.
That's fine. Thank you. You may proceed.
On 1st April 2015, HL acquired 800,000 of the ordinary shares of SK at a cost of 10,280,000 Ghana cedis. On the same date, it also acquired 50% of SK's 10% loans at par. Both investments were acquired from the secondary capital market. The summarized draft financial statements of both companies are...
Okay, so we can see the financial statement, right? We can see that it's a profit or loss statement and a statement of financial position. So let's look at the additional information.
The following information is relevant. The fair values of SK's assets were equal to their book values with the exception of its plants, which had a fair value of 3.2 million Ghana cedis in excess of its book value at the date of acquisition. The remaining life of all SK's plants at the date of its acquisition was 4 years, and this period has not changed as a result of the acquisition. Depreciation of plants is on a straight line basis and charged to cost of sales. SK has not adjusted the value of its plants as a result of the fair value exercise. II. In the post-acquisition period, HL sold goods to SK at a price of 12 million Ghana cedis. These goods had cost HL 9 million Ghana cedis. During the year, SK had sold 10 million Ghana cedis at a cost to SK of these goods for 15 million Ghana cedis. III. HL bears almost all of the administration costs incurred on behalf of the group, invoicing, credit control, etc. It does not charge SK for this service, as to do so would not have a material effect on the group profits. IV. Revenues and profits should be deemed to accrue evenly throughout the year. V. The current accounts of these two companies were reconciled at the year end with SK owing HL 750,000 Ghana cedis. VI. The goodwill was reviewed for impairment at the end of the reporting period and had suffered an impairment loss of 300,000 cedis, which is to be treated as an operating expense. VI. During the year 2015, HL paid dividend of 0.8 per share. SK did not pay any dividend during the year. VII. It is a group policy to value the non-controlling interest at acquisition at fair value. The market price per share of SK at acquisition date was 12.5. Required. Prepare a consolidated statement of profit or loss and other comprehensive income of HL Group for the year ended 31st December 2015 and consolidated statement of financial position as at 31st December 2015.
Okay, so this is a question that we have before us, right? But I have to just run through the basics of consolidation with you quickly before we try solving the question. Are we okay? Now, when it comes to corporate reporting or financial reporting, consolidation happens to be one of the weaknesses of students, but we are going to diagnose it as we go along. So, consolidation is where two entities or more become a single entity. Do you understand? It is based on the principle of substance over form. So we are saying that if I have a parent company, a holding company, that is a company who has acquired more than 50% of another entity shares. You see, the shares of a company is 100%, right? So if one entity buys 70%, for instance, that means the other party will have 30%. Do you all agree? Do you all agree? So the one who has the 70% is the controlling interest.
Please, can you ask those who are not talking to mute because we're getting feedback?
Yes, please mute. Some people's background is very noisy. Especially sometimes you may be quiet by your fan. Some people, your fan is very all right. So you realize that most of the time, if I have 100% in the business, right? The person who has a wider interest, let's say the 70% is the controlling interest because he bought majority of the shares. We say this person has control, so that person becomes a controlling what? Interest. And the one with the minor interest or the minority interest, because it doesn't have control, we call it the non-controlling interest, right? In terms of when we are buying shares in companies, right? Okay. Now, both the controlling interest, which we normally call the parent company, and the what? The non-controlling interest are all investors. So these are the two major investors that we have in a company. It doesn't mean one person cannot buy all the shares, right? One person can, but most of the time, just like you have the majority and the minority in a particular population, in a company too, you have the majority. If somebody owns more than 50% shares, the majority interest is the controlling interest, who we know as the parent company. So the company itself that we buy is what we call the subsidiary, right? The investee. To the controlling interest, it is your subsidiary. So if you buy more than 50% shares in a company, because you control, because the other person will be the minority interest because he has less than 50%, that subsidiary company becomes your what? That investee company becomes your subsidiary company. Does that make sense? So the subsidiary is the company we have invested in. So there are two investors. Who are the two investors? The controlling interest, which is the parent. Are you getting it? And the what? And the non-controlling interest, which are the other investors. Does it make sense? Does it make sense?
Yes.
Does it make sense?
Yes.
Yes, please.
Yes. So the company we are investing in is what we call the subsidiary. All right. But what happens here is very important. Please, and people say they can't see the screen. How? How is it that you can't see the screen? That's what I don't know. Please, and people say they can't see the screen. Is it from my end? Or some of you can see my screen?
I can see.
I can
Okay,
also
that means
see.
it's not from
I can
my
see.
end.
No, you have to scroll. if you are using your phone, move it again to the other side, like scroll it once,
Some
because
people are
there's a
using
third option.
portrait, so you can't see. You have to change it to landscape. Okay. So you must understand the controlling interest, okay? Which I said the controlling interest is what? The parent company, right? The parent company. Then we have what? The non-controlling interest, right? Which are the other what? Investors. Now, all these people are investors who have invested, right? We call this the NCI. In the past, we used to call it what? The minority interest. Now, these two investors have invested in the company, the investee, right? These are investors. They've invested in the investee who becomes the subsidiary. It is only a subsidiary to you if you own more than what? If you own more than 50% of its shares. Are we okay? Now, for the non-controlling interest, they own less than 50% shares. Some people's background is noisy. I don't know. Please be muted if you don't have any. Yes. So this is how it works. Now, if you own more than 50% in a company, it becomes your subsidiary. So there are various investments and their classification. So if I buy between 1%, or let's say between 20%, that means 0 to 19%. You can call it between means 0 to 20. Okay, so let's say 0 to 19%, you have a normal trade investment, not a subsidiary. Are you following? So let's say I invest in a company and I buy between 1% to 19% of the shares. That's a trade investment. In accounting, we account for it under IFRS 9. Okay. Now, when I buy between 20% down to 49%, that means I have an associate company. Okay. An associate, because I have significant influence. That is the ability to participate in the financial and operating policy decisions. Okay. Now, if you have 50%, it depends. It could be a joint venture, an arrangement with another investee, right? To share in the profits and the assets and the rest. Then if you acquire more than 50%, then that company now becomes your what? Your subsidiary. Is that okay? Now, according to substance over form, the parent, that is the controlling interest, I get in it, controls whatever the subsidiary has. It has the power to govern. That's what we call control, the power to govern your financial and operating policy decisions. So it means that you control all the assets because you have the major voting rights on the board of directors, right? You can hire and fire directors. You are subject to variable rights of return or dividends from the entity. Do you understand? Giving you control. So once there's control, the parent and the subsidiary become one entity. So we call that the single entity concept. Are we okay? So because I don't want to waste your time, this is one thing you need to understand. So all assets and liabilities, incomes and expenses of these two entities, though they have their individual financial statements, but we have to put them together because now they've become a group. So a group is a parent and its subsidiaries. I said a group is what? I said a group is what?
Parent and its
Parent
subsidiary.
subsidiaries. Did you hear me mentioning any of these? Did you hear me mentioning associate joint ventures? No. These ones don't form part of a group. So a group is parent and its subsidiary. So any other entity you see on the statement, so far as you can confirm that it is not a subsidiary, it doesn't form part of the group, then you can't consolidate. Consolidation is just putting them together. So putting assets and liabilities together, putting incomes and expenses together so that they become what? A single entity. If you have an associate or joint venture or whatever, it's outside the group. So we usually consolidate those ones using what we call equity accounting. But for parent subsidiary relationship, we use what we call acquisition accounting. For now, don't worry, as we solve more and more, you get used to. Okay. So without much ado, let's see how we go about it. So if it's your consolidated, please put these workings down. If it's your consolidated balance sheet, that's your consolidated statement of financial position. There's a way I do my workings. Okay. So first, we need to determine our group structure. Okay. So always you need to look at the nature of the entities and how they are connected in the group. That's by their share ownership. After I get my group structure, I go for it to get my cost of investment. Okay. So the cost of investment is simply how much they paid. I get it. And the cost of investment is how much the parent paid. And the parent can usually acquire a subsidiary by paying cash, by exchanging shares with each other. You can have a share exchange. Okay. You can have payment in the future, which we call deferred consideration. Okay. You can have contingent consideration, which is a payment in the future, but depending on some particular issue or some particular trigger. Maybe if revenue hits maybe 50,000, I'll pay you this amount, right? It's contingent. It is depending on some circumstances. You can even pay by loan notes. You can even pay by a table. So literally, you can invest in a company by contributing anything. It can be a table, it can be money, it can be anything. But cost of investment is so many things. It can be anything. Then after I get my cost of investment, this is what I paid, right? Now remember that there are two investors. Who? The parent and then what? NCI. And they invested in what? The subsidiary, right? These two investors, I told you they invested in the subsidiary. But this guy, to this guy, it is his subsidiary because he has the controlling interest. That's why we call it the parent company. Now look at something here. If this guy, look, this guy, all his assets and liabilities, which are his net assets, is worth 240,000, right? But this guy, that is the parent company, paid 300,000 for it. Did he pay something extra? This is cost of investment. But this guy's net asset is 240,000. Did he pay something extra? Did he pay something extra?
Yes.
Yes, he did. And because this company has its reputation, has its grounds, has been operating for some time, the extra you are paying for, that is the extra what, 60,000, is what we call goodwill. Do you understand? So anytime you're buying a company, if you're doing financial management, then we can say that this is what we call the cost of acquisition. Okay, so I have been in the system for quite some time. I have made profits over some time. I have reputation with my customers, my suppliers. You have to pay for that. Okay, so that extra is what we call for goodwill. So these investors, both this guy and that guy, are all going to pay something. So for instance, I contributed 300,000. Okay, and this guy here, let's say I was supposed to have 70%, right? But this guy here is supposed to have the 30%, right? Okay. But this guy ended up paying, let's say, 100,000. Okay. So it means that, if we are looking at the assets that we have, this guy should have paid what? 70% of the 240,000. Is that not so? Which should have been how much? That's the share of the parent. How much should he have paid? How much should he have paid? 70% of the 240. How much should he have paid? And this guy too would have paid what? 30% of the same 240,000, right? So how much is the value? Please, you should have your calculator by you. How much would the values be? Or become?
160,000.
So the parent should have paid 100 and what? 60,000.
68.
And this guy, you said 100 and what?
68,000.
So 68,000. And this guy?
72,000.
72,000. Okay. But see what they paid. This guy ended up paying 300. This guy ended up paying what? 100. It means that they paid extra. So anytime something like this happens, both parent and NCI are all contributing to goodwill. We say that this is fair value method. Okay. That means both NCI and the parent are all contributing to goodwill. When NCI doesn't contribute to goodwill but pays a proportionate share of the net assets, that means NCI pays exactly this 72,000. It means that that is what we call proportionate share. So NCI can be valued using full goodwill method or fair value method, meaning that NCI has a share of the goodwill, like what we are seeing here, where NCI pays extra above what it is supposed to pay. Okay, but sometimes NCI, because he is the minority interest, only pays for the right amount of the net assets. That means it's proportionate share. So NCI is valued using two methods. The first method is where NCI has a portion of the goodwill. Okay, and where NCI does not have a portion of the goodwill. So using this scenario, you see that the share of the net assets that they have, I get it. If we are doing goodwill, if I put parent here and I put NCI here and I put the total here, you realize that when we look at their cost of investment, how much did they pay? The parent paid how much? 300,000 also, and NCI paid 100,000. True or false? Meaning their total investment or their total cost of investment was 400,000, right? But what was their share of net assets? How much should they have paid? Parents should have paid what? You said he should have paid 168,000, right? And this guy should have paid 72,000. How much extra did they pay? How much extra did they pay? That becomes your goodwill. So goodwill is where your cost of investment exceeds your net assets. So the parent paid how much extra? The parent paid how much extra? 132,000, right?
Yes, sir.
And this guy paid how much? 100 minus 72?
28.
28,000. Yes.
Yes.
So overall, the total is how much? 160. That means that this company is worth 240, but you paid something extra for it, which is 160. Now, according to IAS 38, intangible assets, an intangible asset is what? An identifiable non-monetary asset without physical substance. Okay, so goodwill, so far as it is purchased, it is identifiable because it arises out of a contract, or you can even determine it separately from your business. So this is an asset, and as such, it should be part of the group asset. It should be consolidated. So we call this consolidated goodwill. Okay, you paid for it. You paid this extra. It becomes an asset to the group. So as such, you shall treat it that way. Did we get the concept of goodwill? So I said something about proportionate share of NCI and then the fair value method. When it's proportionate share, what happens? When it's proportionate share, what happens? I said something here that NCI, we value it using two methods, fair value method and proportionate share. When it's proportionate share, what happens?
It means that the NCI paid exactly what it's supposed to pay.
Yes, it pays exactly what it is supposed to pay. It doesn't pay for goodwill. When it's fair value method, NCI pays for goodwill. Are we okay? So though we are accounting for the parent, okay, anytime you're preparing consolidated financial statements, you are preparing the account for the owners of the parent, but the owners of the parent control the whole subsidiary company, right? So they also have to see the effect of the other investors. Okay, so the other investors, what are they worth in the company? That's what the NCI stands for. Okay, then you prepare your consolidated reserves, or let me just put here your consolidated retained earnings and other reserves. So your consolidated reserves, you must know how much the parent has. Are you getting it? Then if there are other workings, like if there's an associate, we must also learn how to deal with associates. So usually when I'm doing consolidation, basic consolidation, these are my workings. Are you getting it? Yes. In between, we'll have consolidated adjustment. Usually I don't call them a working because they are everywhere. You can even create a separate working for it. These are the standard things you need, but in between, there'll be some adjustments that need to be done. So this is what you do when you are doing the balance sheet. Okay, standard workings. So put the workings down, because as we go on this journey, we'll do a lot of questions so that you get the whole idea behind consolidation. And consolidation is 20 marks under financial reporting and then 25 marks under corporate reporting. But the 20 marks part is what we are doing for both corporate reporting and financial reporting. The 5 marks is the consolidation theory for those who are doing corporate reporting. So please put this working down quickly. Then I can go to your statement of profit or loss. So the workings, I will separate them into two. What we've seen so far is what I do for the balance sheet. And some people also adopt a different strategy, but this is what I adopt. This is what I adopt for my style. Are we okay? Some people just jump from group structure straight to net assets, and then within the goodwill, they do their cost of investment. But I like to separate the cost of investment. I get it. I don't like to include it as part of the goodwill. I just include one figure as part of the goodwill computation. Please, if you are done, you tell me, then I write the approach for the P&L. Now, when it comes to the statement of profit or loss and other comprehensive income, there's a set of workings that you also have to prepare. Good. So with this one, if it is given, the same way you have to do your group structure. These are the workings, right? You have to do your group structure. Now, after your group structure, because usually you will still be having all these things. Most of the time, goodwill impairment is an expense. Goodwill impairment itself is an expense. So most of the time, you have to still do these same workings that you see here. That's if the P&L comes separately. Are you okay? But then usually you can have some intra-group adjustments, right? Intra-group adjustments, like intra-group trading and some things, right? Then there's one important working that you need in the P&L, which is NCI share of the profit. Remember, I told you that NCI is an investor, the same as the parent. So the NCI must have a share in the subsidiary's profit. Are you getting it? And its total comprehensive income. This is the most important working. After that, any other things that you see, I get in it. So this one carries a lot of marks in the exam. So a lot of students actually ignore this NCI share of profit, but you don't have to. So these are the most ones. So this intra-group adjustment has other things like intra-group sales and all other things, but these are the most important workings you have in the P&L. Sometimes they can ask you to calculate goodwill impairment. Okay, and to do impairment, you definitely need these workings again, because cost of investment, that's this working 2 minus this working 3 actually gives you your working 4. Do you get the whole idea? That's why I arrange mine like this. It's not a coincidence that I pick my workings like this, because cost of investment minus net assets gives us goodwill. And that goodwill must be shared for parent and this guy. Do you understand? So I go in that manner. So put this down and then let's start our question. If you have any question, you can ask before we move. As we solve more and more questions, I'll also be teaching you different concepts. So who has any question? If you have any question, you can ask before we start diving into, yes. Even I can add one, which is share of associate profits, right? Share of associate profit. Okay, so if there's an associate, we can share the associate profit and other comprehensive income, okay? Which is also another working, which you can have in Are you done? Are we done?
I hope we'll get the class notes. Or
You said?
are you
Yes,
going to get the
we are done.
class?
Please, your voice is far away. I can't hear you.
Saying, I'm asking if we can get the note because some of us we can't write as of now.
Unless I share the Excel file.
Yes.
Okay, I'll try and share the Excel file. All right, so that is it. Good. Now let's deal with the question we are solving. Okay, so this is the question we are solving, right? So anytime you want to solve every statement, you use oral. Oral is one of the methods I use for solving financial statements, no matter what it is. And how do we deal with oral? Oral is open required account. You open all the required accounts, you leave them blank initially. You read the question and pick your easy marks. You do your adjustments and line by line, you solve. So that's what we are going to do. Here we are doing P&L and balance sheet. So what we are going to do is you open those accounts and leave them blank. So the first thing is you bring the group. HL was acquired. The controlling interest. So HL group, you call it HL group. Then you say what? Consolidated. Okay. Consolidated statement of financial position as at 31st December 2015, right? Then you bring your currency figure. It was Ghana cedis. Okay. That's the reporting currency. Now I come here. Then the same thing, I do my P&L, right? So HL group, consolidated statement of profit or loss, and other comprehensive income for the year ended 31st December 2015. All right, so we have this. Now, the same way you bring your currency, your reporting currency. Good. Now, this is what I want you to do. Immediately that you put this down, you have to go and establish your group structure. Why? Because you need to check whether the entities that you have, are you getting it, are subsidiaries or they are associates. You need to always confirm that. So once we have this, the first thing I'm going to do is establish my group structure. So that's my first. When I come to my workings, you remember that I told you that always come with a group structure. So the group structure is what will tell me what I need to do. So that my first working is my level of control. Okay, my level of control, or what we call the group structure. So I'm going to establish my group structure. Okay, so here lies the case. When you read it, the very first paragraph says that what? On 1st April 2015, HL acquired 800,000 of the ordinary shares of SK. So you bought 800,000 shares in SK. But how many shares did SK have in the first place? When you go to the balance sheet, that's where we find the share capital, right? So when we come here, stated capital, there are 2 cedis each. Can you all see? Is it not 2 cedis each? Is it not 2 cedis each?
Yeah, it is.
And it was 2 million, right? 2 million share capital. So you are saying that when you are looking at SK's shares, the shares were not quoted directly, but you know that the total shares, the share capital that this guy had was actually what? 2 CDs times some number of shares, right? True or false? And that gave us what? That 2 million or that 2,000 we are seeing there. Do you all agree? So you are saying 2 CDs times some number of shares came to give us that 2 million or that 2,000 we are seeing. So that means how many shares that this guy have? We are working in thousands, so you must understand what I'm saying. Or let's write it well. Some people may not get it. Does it make sense? Or who doesn't get it? Because you see here is 2,000 in SK's books. That's 2 million because you are working in thousands. So 2 CDs each means that this 2 million is Ghana cedis. So some two cedis times some number of shares gave us that 2 million shares. Do you all agree? So how many shares gave us the 2 million? It means that if I want to get the number of shares, how do I do that? I must just divide this 2 million by what? By the 2. Does that make sense? And that means this guy has how many shares overall? That means this guy has 1 million shares. Do you understand? So if this guy has 1 million shares and the parent acquired 800,000, that means the parent acquired 800,000 out of what? The 1 million shares. No be so? And what percentage is that? If I multiply this by 100, that means the parent has what percentage? 80%. True or false?
True, 80%.
Did you see how we got that? So we played with the share capital. So if the overall shares were 1 million and I acquired 800, that means I acquired 80%, right? That means NCI acquired what? That means the other investors acquired what? The rest of the remaining 200,000, right? True or false?
Yes, 20, which is 20%.
Yes. So that means these guys have what? The remaining 20%. Are you getting it? So we already know that this is the structure. So I'm going to put it in a nice way. So I'm going to bring what? SK here. This is how you actually do the group structure. This is my style. Some people use the diagrams. I don't prefer that one. I prefer this one because this one speaks a lot. So SK is the subsidiary, right? Then we have HK, which is the parent. And we are saying that this guy acquired what? He acquired 80%, right? So the NCI has what? 20%, making 100, right? Of the overall subsidiary. Good. Now, the thing you bring here is the date of acquisition. When did we acquire this guy? When did we acquire this guy? We acquired him on 1st April 20 what? 2015. Is that not so? And when is the reporting date? Date of reporting. Like when are we actually preparing the accounts?
December
31st December 2015, right? The same day. The same year, sorry. So what's the difference in reporting? The difference in reporting tells us so that we can manage or measure something we call mid-year acquisition. So this one was a full year, right? We have this subsidiary for a full year. Sometimes you can have a subsidiary who you acquired within the year. So it's not a full year subsidiary, but this guy, we have him for a full year. Okay. So this alone has given us the group structure, which we have gotten, right? So once you are able to find the group structure, the next thing is your what? Your cost of investment. But before you do that, now you have been able to confirm that you have a subsidiary. SK is a subsidiary. So immediately you know you have a subsidiary, go and consolidate assets and liabilities and also consolidate income and expenses. What did I say? Immediately you establish your group structure, what should you go and do?
Establish your income and
Consolidate assets and liabilities, expenses,
assets.
and revenue.
Please, but the April to December, please, is it 1 year?
I thought it was January. April, yes. It's not 1 year. It's a mid-year acquisition. Thank you. I even forgot to. April to December, I believe that's 9 months, right? Yes, so it's a mid-year acquisition. Sorry. My mind made me that it is January. Please, are we okay?
Yes, and
Okay, so it's a media acquisition. So once you have been able to notice, remember, we cannot apportion assets and liabilities. Once you have control, you have full control. Okay, but your expenses and income you can apportion. So once I come here, this is a financial position. So immediately I will go and add assets and liabilities. So I will start off and say what? My non-current assets. Are we okay? So we start with what? Non-current assets. So with the non-current asset, you remember I told you that consolidated what? Goodwill. Usually it is something you have to record. Usually people forget the consolidated goodwill. Okay. People forget the consolidated goodwill. So that's the first thing you bring. It doesn't mean that should be the first thing you bring, but you are likely to forget because it's not on the original statement. So you go and work for it. Then all other ones will follow. So property, plant, and equipment. Okay. So property, plant, and equipment, right? Property, plant, and equipment. So you can do a schedule for all that, but you can open brackets and add up assets and liabilities. So that means this one, I'll add my 19,320 plus my 8,000, okay? Because I know I have a subsidiary. Then we come to what? Investments. So when you come to investment, usually investment is the investment in subsidiary, but there may be other external investment. So you add up, we'll come and eradicate how much we paid in the subsidiary. The funny thing about consolidation is, yes, they are single entities, but once you become a group, you are one single entity. Okay, so you can't invest in yourself, you become one. So since I can't pay investment to myself, I must eradicate any transaction between the myself. Okay, you can't have a transaction with your own self. That's the whole idea. So this one, the investment was what? 11,280 plus what? Plus 0, right? Plus nil. Okay. Then we have what? Current assets. So when we come here, we have our current assets too. You see what I'm doing? I'm just adding assets and liabilities line by line. So current assets, we have 15,000 plus what? Plus 8,000. Good. All right. Then you come and get your total assets, but I go straight to equity here. So equity and liabilities. So under equity and liabilities, we go to equity. So under equity, we have stated capital. And our stated capital is the parent only, okay? We need stated capital for only the owners of the parent. So usually I open bracket and put only the parent shares there. And the parent shares was 10,000. Why didn't I put it here? Because there may be a share for share exchange. So if there was, I'll come and add it. But now I don't know what is there. Then I now come to what? Income surplus or your retained earnings, right? So anything concerning reserves, you go and work for it. So retained earnings, I'll put the work in because I'll go and work for it. Then there's something which is not on the statement, but I told you need, so far as you've sold the controlling interest, you also need to show the non-controlling interest so that we know their position in the company. This one is also not in the account. Just like goodwill, was not on the face of the account, this NCI is not also on the face of the account. So students are likely to forget all the time. So let me put asterisks there. Make sure you never forget goodwill and NCI, because sometimes people usually forget them. Are we okay? So this is what we have. Now, then you come to your liabilities. So when you come to non-current liabilities for this guy, we had what? 10% loan notes. So 10% loan notes. Okay. So it was 0 plus what? 2,000. Okay. Then you come to current liabilities. Current liabilities, that is 10,000 plus what? 3,600. Okay, good. Now you see all we did. We just added assets and liabilities line by line. Okay. When you go to the P&L 2, you should be able to what? Add revenue and expenses, or income and expenses line by line. But here lies the case. We had a subsidiary for 9 months, April to December. So you must apportion the income. So the same way, if you take revenue, it will be parent. That is what? 60,000 plus what? 9/12 of the 24,000 that we have for the subsidiary. Can you see? The same way, if you come to cost of sales, you do the same. So your cost of sales too will be what? 42,000 plus what? 9/12 times the same 20,000, right? Then that gives us our gross what? Our gross profit. Okay. And gross profit is a balancing figure. You don't touch profits, because so far as you do this, it will change the profits. Then you come to your operating what? Operating expenses, right? Operating expenses. So operating expenses, we have what? 6,000 plus what? 200. Okay, 6,000 plus what? 200 times what? 9/12. Then we have loan interest received or paid. So finance cost or investment income. So we have loan interest received or paid. So one is investment income, one is investment finance cost. So when you look at it carefully, one is positive, an income, and one is an expense. And the expense seemed to be more than, so we have plus 75 minus 200. That's what was there. However, you can make a finance cost and investment income. So you leave it there. Then this guy's 200 was also 9/12, right? Yeah. So anything the subsidiary has is always apportioned if it's mid-year. So based on this, we have our profit before tax, which is also a profit element. Then we have income tax expense, right? Income tax expense. So this approach will save you a lot of time. So income tax is 3,000 plus 9/12 times 600. Okay, then you come and get your profit for the year. Now you realize I have input. So profit after tax, right? So this profit after tax will now come and add our other comprehensive income. So other comprehensive income to it. And this other comprehensive income, in the question, we have only 1,000 for this plus 0. We don't know which we will add. And when you add everything up, that gives you your total comprehensive income. But remember that I told you whatever profit the subsidiary makes, 2 people will share. Who are they? The parent and then what? The NCI. So now you are going to take the profit after tax that you have. That's why people don't like the P&L. It can be stressful. So you are now going to take the profit after tax that you see the N share. Okay. So profit after tax attributable to. Okay. So you say profit after tax attributable to 1. The owners of the parent, or let's call it the group. The group is for the parent, right? Then 2, the non-controlling interest. Remember, you must share the NCI's profit. So the group plus the non-controlling interest, right? Working. Then the same way you come and share the total comprehensive income. So you say total comprehensive income. Total comprehensive income attributable to, the same way you attribute it to 1, the group, and 2, the non-controlling interest. So you attribute it to the group, and 2, your non-controlling interest. And this one, you go and work for it. So now that you've been able to lay out your pro forma like this, you are now going to tackle the workings. So you see how I did it. I opened the required account. I left it blank. I went to do my group structure to confirm whether I have a subsidiary. Then I came to add assets and liabilities, income and expenses. So now I dive into the notes. So we saw that this guy acquired 800,000 at a cost of 10,280, right? At a cost of 10,280. They've already given me the cost of acquisition. They didn't tell me whether there was a share exchange, nothing. So it was straightforward. So my cost of investment has already been given, right? So working number 2, my cost of investment. And this one was straightforward. So in that case, this cost of investment, possibly, they've already given it to us. And that was 10,280, right? This has already been given. Now, remember I told you you cannot invest in yourself. So any cost of investment is supposed to be taken out of your investments, right? So this 11,280, I must minus the 10,280 from it, because that 10,280 is amount that I've paid to myself, literally. You have paid a subsidiary who has now become one with you. So this 11,280, you have to take out the 10,280 from it, so that you are left with only external investments, because we can only recognize things we have invested outside, but the ones within the entity must be eradicated. You can't invest in yourself. So you see, I took out the 10,280, which is investment in yourself. So that is done. We've gotten our cost of investment. Now, we need to prepare the net asset of the subsidiary. So there are so many ways we do this, right? But I prefer you use the latest roll forward method. So you prepare net asset list of the subsidiary, which is SK. And this is what you do. You take all the net asset at the acquisition date. So net asset at acquisition date. And you take the net asset at the reporting date. Okay. Take the net asset at the reporting what? Date. All right. So there are so many ways you can kill a cat, though, but you can go this way. Are you getting it? And prepare your net assets list. So your net asset is actually your total assets minus your total liabilities. But remember, total assets minus total liabilities is also the same as equity, or the same as net asset. So instead of preparing a statement of account that is getting all your assets at a particular date, that is getting all your assets and liabilities at 1st April 2015, and getting the same at 31st December 2015 can be a lot of work. So why not go and take the equity side? So you can just take the equity side and bring it here, which is still the same as your total assets minus total liabilities. So I can take my equity side by taking my stated capital, right? And this is only at the balance sheet date, the reporting date. So I can take it, and it is assumed share capital wouldn't have changed. So the subsidiary share capital was 2,000. So this 2,000 is at this date. It is assumed it never changed. It will still remain 2,000. Then we have our retained earnings or income surplus, right? Retained earnings. Now you can see that the one on the balance sheet, the retained earnings, was 8,400. You can see that, right? It was 8,400. But what is the retained earnings that will be here? Most questions will tell you that on the date you acquired the subsidiary, okay, its net assets was this, or its retained earnings was this. Are we okay? But here lies the case. This one, they didn't tell us what the retained earnings was. So anytime you acquire a subsidiary in the same year, to get the retained earnings at the acquisition date, all you have to do is take. So anytime you want to get retained earnings at acquisition, okay, when it's a mid-year acquisition like we are seeing like this, right? This is where the complexity is, but I don't think it's complex. all you have to do is take the retained earnings at the balance sheet date, okay? And just subtract your portion of the contribution. So here, how many months did I have the subsidiary?
9 months.
You had him for 9 months. So you are just going to take your retained earnings at the reporting date minus 9 months of the subsidiary's profit after tax, right? Because you only contributed towards the 9 months. You want to see what was there before your contribution. So that's how you get your retained earnings at acquisition. So if you look at this guy, his total retained earnings on the balance sheet date was what? Was 8,400. Is that not so?
Yes,
Was it
sir.
not 84? Then you will now take what? 9 out of 12 times, because this is your contribution. You are taking out your contribution from it to get what was there before your contribution. So the guy who gave the girl everything when they met in April up to December, now they are breaking up. What happens? You have to take out everything you have to see what the girl had before you met her. Do you understand? So this is what is happening. So how much profit did this subsidiary make? You see, the subsidiary actually made profit for the year of how much? Only 3,000. So if the total retained earnings or profit he had was 84, and you contributed 9 months of the 3,000, then what did he actually have before you came to add this up? Do you get the idea? So we want to see what was there before you had to add your contribution. Your contribution was 2,250. So this guy had 84 and you contributed 2,250 to get the 84. So what was there before this 2,250? Do you all get it? It means that this subsidiary had 6,150 before you came to contribute your 2,250. Does it make sense? Good. So that means the net asset at the acquisition date is supposed to be 6,150, meaning that she had 6,150 before you met her. Now she has 84. It means that you added how much to it? You came to contribute additional 2,250 to it. Do you understand? Which is the extra benefit you added for this guy to grow. Who didn't get the concept? Or everybody's fine now?
Yes, sir.
Good. So now that we've done this, we continue. Now, it says here that the fair value of SK's assets were equal to their book values with the exception of its plant, which had a fair value of 3.2 million in excess of the book value at the date of acquisition. Now, look here. When I bought you, your assets were at their book value, right? But now we have realized that some of your assets have a value more than their book value. It means I must adjust the net asset by that amount, right? Yes. So you made a mistake 9 months ago in your books. That means for both sides, I must adjust that mistake, right? But if a plant was recorded at, let's say, 6 million, okay, instead of 9.2, what adjustment do I have to do? That means both sides I have to go and add that 3.2. True or false?
True.
True or false? Now, this mistake that I did, wouldn't it have cost me? That means I was depreciating lower. True or false? You see, I was
True.
supposed to report 9.2, but I recorded was 6. That means I depreciated 6 instead of 9.2. So that means this extra 3.2, I have not recorded its corresponding depreciation. Do you all agree?
Yes, sir.
Yes, sir.
So because of that, when I pass this adjustment, the corresponding depreciation on this 3.2, I must also adjust it. Because instead of adjusting the whole 9.2 with its corresponding depreciation, I only adjusted 6. That means the extra 3.2 must also come with depreciation, which I must record in the account. I believe that is fine with everyone.
Yes, sir.
Good. So, as I said, we will go there and say what? Fair value adjustment. For what? It was what? A plant. Is that also? They say with the exception of a plant. So it's a plant. So first correct the mistake. That 3,200, you correct it at both sides. But remember that there will be what? Fair value depreciation. Okay? So this fair value depreciation too, we must adjust it. So the fair value depreciation, how do you adjust it? Okay? we can do it where we had our workings down here. It doesn't matter. So I can say fair value depreciation for plant. Okay. Now we are saying that the adjustment was what? 3,200. But the plant had how many years remaining? Remaining life of the plant. It was how much? Please read and tell me. What's the remaining life of the plant?
4 years.
It had 4 years, right? Good. 4 years. So the plant has 4 years. So that means the depreciation per annum is what? 3,2 divided by 4 years. That's how much?
800.
800, right, per annum. But did we have this subsidiary? How many years did we have this subsidiary?
9 months.
9 months. So that means our accumulated depreciation is only for what? 9 months, right? Which is 9 on 12 times this 800. And that gives us what? That's 600, right? So this 600 must affect our extra asset that has been brought, right? So literally this 600 must reduce this because it can't affect this date because this is where we started. So the accumulated one is what must come. So here is nil, right? So this 600, remember everything that happens at the reporting date is the balance sheet. Net asset is the same as the balance sheet. So we must go and adjust this. So when I go to my PPE, I'm going to add the 3.2 and take out the 600. Do you get it? So this is a fair value adjustment. So this is a fair value adjustment and this is a fair value depreciation. I hope that is clear. So you see, when you open the account and leave them there, once you do every working, you just pass them on the account. Because assets increased by 3.2 and reduced by depreciation of 600, you pass it here. Let's come to the P&L. The depreciation, is it not an expense?
Sure.
Where does depreciation go? They said depreciation is charged to what? It's charged to what?
Cost of sales.
Cost of sales. So plus how much? How much goes to the cost of sales?
600.
Plus 600. So this 600, we are going to add it to the cost of sales. You see how you go about it. So that is it. So we continue. Are we okay? Now, the next thing we see is the post-acquisition period. Now, let me ask you a question. This adjustment, whose books was it done? In
The
whose books was
subsidiary.
it done? The subsidiaries books. Thank you. So it means that so far as it was done in the subsidiaries books, that means it affected the subsidiaries profit. True or false?
True.
Yes. So there's one working we call the NCI share of profits, right? Subsidiaries profit and total comprehensive income. This is the most important working in the whole profit or loss account. So this working, we put the subsidiaries profit and any adjustment that affects the subsidiaries profit, you have to adjust it here. Okay, it's a separate working that is shown. You remember that on the face of the account, we said something down there. We said what? Profit after tax attributable to parent and NCI, right? That NCI share of the profit that will come here. You need to create a working for it. And in P&L, this is the most expensive working. If you don't do this working, like your whole P&L is waste because this is the most important working. So if I take the subsidiaries profit after tax, how much was it? The profit after tax of the subsidiary was 3,000, right?
Yes, sir.
Yes, sir.
But it's only 9 months of it that we need, right? Because that is when acquisition had happened. And this was 2250. True or false?
True.
Yes. This was 2250. Okay. But then there will be some fair value adjustments. What adjustment did we have? We had fair value depreciation. Do you remember? Of how much? 600. So this 600 affects this profit. So you leave it there. So anything that affects the subsidiary's profit, you come and adjust it here as well. So as we are adjusting it in the account, you're adjusting it here as well. So that's how we go. Okay, so we go back to our workings. Yes. So the next thing was that they said in the post-acquisition period, HL sold goods to SK at a price of 12 million. Let me ask a question in this class. When we started, I told you that once you become a group, what happens? Once you become a group, what happens? You become one person. Can you sell goods to yourself?
No.
No.
you can't sell goods to yourself, right? Yes, so you can never sell goods to yourself. So the first thing you do is that when you get intra-group trading, if you are doing the profit or loss statement, the first thing you do is to cancel the sale because you can't sell to yourself. I said the first thing you do is what?
Cancel the sale.
Cancel the sales.
Cancel the sale so far as it was within the group. So there was intra-group sales. So intra-group sales, I create a working for it and say intra-group sales. On the balance sheet, we don't cancel the sale because we can't see the sale. It's a transaction. So cancel the sale means first, reduce your selling price. So debit to reduce sales and credit to reduce what? Cost of sales, right? So the sale, how much was the sale? He sold the goods for how much? 12,000, right? So cancel the sale. Reduce sales by 12,000. Reduce cost of sales by 12,000. That's a cancel the sale. You can't sell to yourself. You are one person. You can't sell to yourself. So in that case, the first thing you do is to cancel the sale. So canceling the sale means I said reduce sales and reduce cost of sales. So I come here and say sales. I must minus what? The intra-group sales of what? 12,000 from here and minus it from cost of sales as well. 12,000. Good. But then once you do this, the next thing you have to do is to what? Add back the unrealized profit to cost of sales. Remember, this 12,000 that you are taking out of the cost of sales, you are taking a bit of the profit along with you because this is selling price. You cannot deduct selling price from cost. So add back the profit portion, okay, to adjust your profit. So I'm going to add back unrealized profit. So this is where you ask yourself who sold to who and therefore who made profit. Who sold to who? Was it the parent who sold to the subsidiary or the subsidiary sold to the parent?
Parent to subsidiary.
Parent sold to subsidiary. That means the parent is the one who made the profit, right? So
Profit,
if parent
yes.
sold to subsidiary, that means parent made what? Profit. No be so. Good.
Yes.
So always, we must always debit to reduce the seller's profit. That's a rule. Is the seller. Now you are in a group. You have sold eggs to your wife and made a profit. Is that profit real or not real?
Not real.
It's not real because it's still within the house. Do you understand? So it must be eradicated. So you must reduce the seller's profit and reduce the buyer's inventory, which if the buyer is part of the group, the buyer's inventory is also within the group. So you must eradicate this. Are we okay? Now, in the P&L, reducing group inventory means increasing your cost of sales. That is simply it. So if you are doing this, that means in the P&L, you reduce your group inventory by increasing cost of sales because inventory reduces cost of sales. So in that case, first, we must find our realized profit. That's where it gets interesting. You must be good with markups and margins. As we go along, we'll do more. Now, these goods had cost how much? 9 million, but we sold it for how much? 12 million. So what's the profit on the goods?
3 million.
3 million because we sold it for 12 million and they were what? 9 million, right? So what happens? That means there's 3 million profit, overall profit on these goods. Good. This is overall profit, but this is not the unrealized profit. This is just the overall profit on the goods. But they are saying that this guy has sold 10 million, I get an at cost to SK of these goods for 15 million. Oh, okay. So this is the price, right? At a price of 12 million. But during the year, this guy sold 10 million of these goods for 15 million. Are we okay? So we are saying that out of this 3 million profit, there's some that has been sold. That one is realized. But what is the unrealized portion? It means how much has not been sold yet? How much of these goods has not been sold yet?
2,000.
2,000 has not been sold. I bought it at 12,000 from you, but I sold 10 million. That means the unrealized profit portion is what? If I take the total profit and multiply by the 2,000 out of the total 12 million, are you getting it? Then I could say that, okay, I've been able to tell how much of it, because the whole thing was what? The whole thing was supposed to be what? 12,000, right? But the 2,000 portion that has not been sold yet, that profit on it is what is unrealized. Does it make sense?
Yes.
Good. So this times 2 out of 12, that is 500. So 500 of these is not realized. Okay, it's unrealized. The question is interesting. No? It's funny I haven't. It's very interesting. So this 500 is not realized, it's not real. But however, the 10,000 out of the 12,000, right? Times this 3,000, that one is realized profit. So that is what? About 2,500. That one is real profit. So that one we can leave it in the group, right? But this one is not realized. So in that case, we adjust it. So in that case, in the P&L, we must go and add it back to our cost of sales. So we say cost of sales plus what? 500 being the unrealized what? Profit. Are we okay? But if we were in the balance sheet, we must debit our seller's profit. Who was the seller? The parent. Where do we find the parent's profit? In the retained earnings. True or false? So we are going to reduce the parent retained earnings with 500 and reduce group inventory with what?
500.
500. Where do we see group inventory? The balance sheet. Do we have current assets there? Yes. So minus 500 being the group inventory, the unrealized profit. So this unrealized profit will reduce our current assets because you must reduce it from your group inventory. I know some people, this sounds strange, but don't worry. As we go along, you get a hang of it. Okay. So that is how you do about it. You see, consolidation is a bit mechanical, but I'm trying to simplify it for you. If you've done it before, you realize I'm going very simple, like I'm breaking it down for you. Okay. And once you get these mechanics, you see that every consolidation question, you have the flair. All right. So that is how we go about this. Now, the next note. It says that HL bears almost all of the admin cost on behalf of the group, invoicing, credit control, and it does not charge SK for this service, as to do so would not have a material effect on the group profit. So this one, do you think there's any entry that needs to be passed? Do you think there's any entry that needs to be passed? I'm just testing people's mind. No, they've already told you it has no material effect. So it has no material effect. So we leave it. Now, revenues and profits are deemed to accrue evenly throughout the year. They've told us that. The current accounts of the two companies were reconciled at the year end with SK owing HL 750. Can you owe yourself?
No.
You can't owe yourself, right? Since I cannot owe myself, any owings that I owe myself must be eradicated. So I can come and say, okay, intra-group balances. So anytime you owe yourself, we'll come and do difficult one, intra-group balances. You cannot owe yourself, right? So who owed who? Who was owing who? Subsidiary was owing what? Parent. How much? 750. But now you are a group. So anytime there's intra-group balances, reduce them. Okay, so I must debit to reduce my payables by how much? The group payable by 750, right? And credit to reduce my group receivables by how much? The same 750. So it's like I'm reducing payable by 750. I'm reducing receivable by 750 so that I cancel it. You cannot owe yourself. You are one person now. So I go to the balance sheet and say current assets minus 750, right? Which is the intra-group balance. Then I come to what? You cannot owe yourself, current account. Then I come to current liabilities and also take out that 750 intra-group balance because payables are current liabilities. You cannot owe yourself. Since you cannot owe yourself, you must cancel each other. But there was another intra-group balance. Where is it? You see, when we started the question, it told us that you acquired 50% of SK's 10% loan notes. Do you remember?
Yes.
Now, can you buy loan note in yourself? Can you buy loan note in yourself?
No.
No, you cannot. I told you now you've become one person. If you've become one person, how can you buy loan note from yourself? So you must eradicate it as well. It's an intra-group balance. So that loan note acquisition that we saw is also an intra-group balance. So you must also eradicate it. So loan note acquisition, you must eradicate it. The same way, I'm going to debit to reduce my loan notes because it's now part of the group, and I'm going to credit to reduce my what? Cost of investment or my investments, because one, investment is long-term receivable. This is a long-term receivable. This is a long-term payable. So it's the same thing I'm doing. See, debit payable, credit receivable, debit payable, credit receivable. That's it. So the loan notes, we acquired what? 50% of the 10% loan notes. So 50% of the 10% loan notes. And this guy's loan note was what? It was 3,000, 2,000, right? So 50% of the 2,000 means that we bought loan notes of 1,000. So eradicate 1,000 and eradicate 1,000 from investments. So that's it. So debit 1,000 here, debit 1,000 here. So when I go to my balance sheet, I'll go to investments. You see, investments was 11,280. Truly, when I take out that 1,000, what is left? Is it not zero?
Yes.
Yeah, so it means that this 11,280 was how much I paid for the subsidiary and how much I paid for the loan note. So you see, I've eradicated it. The same way when I get to loan notes, 10% loan note, 0 plus 2,000 minus the 1,000, which is an intra-group adjustment we just did. So you see, you eradicated it from long-term investments and you're also eradicating it from what? Your payable. That is your long-term payable. So that is it. Okay. It says what? The goodwill was reviewed for impairment at the end of the reporting period and has suffered impairment loss of 300,000. Goodwill impairment, is it not an expense?
Yes.
It is an expense, right? So goodwill
Yes.
impairment, since goodwill impairment happened after acquisition, I see students apportion goodwill impairment. No, it happened after you had a subsidiary, which is the 9 months period, right? So it's already 9 months. There's no need to go and apportion it. Impairment is not apportioned because it happened after you had a subsidiary. So since it's an expense, you go to expenses, and in whose books was that impairment? Is it not the subsidiary's books?
Yes.
Yeah, so anytime something affects the subsidiary's books, it affects the NCI share of the profit. So the same way we say we have goodwill, what? Goodwill impairment. It affects this working that we had, the subsidiary share of profit. And they said this was 300. So this 300 must also affect this. But since it's an expense, in our P&L, they said it goes where? The question will tell you where to put it. Where did he say it goes to?
Operating expenses.
Operating expenses. So I come to operating expense and say plus. Some students will go and subtract. It's an expense and you are under expenses. Why are you subtracting? You add. So since an additional expense of what 300, we come and add the 300, which is our goodwill what impairment. But it also affects our goodwill. So since there was nothing that happened again, we can close off our net assets. So let's close off our net assets. Then we get our net asset at acquisition and our net asset at reporting date. So we have 2,000 plus 6,150 plus 3,200, and that is 11,350 for this guy. And then we have 2,000 plus 8,400 plus 3,200 minus the 600, and that is 13,000. So when I met you, you were walking. Now you are driving Mercedes Benz. I must have a share of the growth. True or false?
True.
Unless maybe I want to dash it to you that, oh, I've done some for you, but I have a share of the growth. So the growth in net assets, I must have a share. So what is the growth in net asset? Your net asset is now 13,000, but before it was 11,350, right? So how much have your profits grown? That's 16 what? 1650. This 1650, I must have a share of it. But however, this 11,350 is what your net assets are worth at the date I bought you. We have to go and check whether we paid extra. And that extra is what we call goodwill. So I come here and say goodwill and say, what was my cost of investment? How much did the parent pay for the subsidiary? In the question, we saw it 10,280, right?
Yeah.
Yeah, he paid 10,280. So there are two investors. How much did they pay? Parent paid 10,280. What's the fair value of NCI? How much did NCI pay? So if the question is silent, you just take a proportion of the net asset. But here, they told us that NCI was fair valued. I believe so. It says the group policy to value NCI at acquisition at fair value. The market price per share of SK was 12.5. True or false?
True.
So that means the NCI paid 12.5 for this. Now, how many shares did the NCI buy? We already have it in our question, right? How many shares did the NCI buy? They bought 200,000 shares. True or false?
True.
And they are now saying that it was valued at 12.5. So you bought 200,000 shares at 12.5. So in that case, fair value of NCI would become the 200,000 shares that we bought at 12 cedis, 50 pesos. So you need to know how much those two investors paid, right, at 12.5. So 200,000 at 12.5, that is 2.5 million. But because we are working in thousands, it becomes 2,500. That's the value of NCI. So now that's the total consideration both investors have paid. So you have paid a total consideration of how much? So far as NCI is fair value, it means NCI paid a portion of the goodwill. So the 10,280 plus the 2,500 gives us 12,780 as the total consideration. Now, when your consideration exceeds your net asset, we say you have goodwill, right? So if this is your total consideration, we are now going to take the fair value of our net assets at acquisition. So what's the fair value of the net asset at the acquisition date? So you go to your net asset. That's why I do cost of investment, which we've seen, and then the net asset. The net asset at the acquisition date was what? 11,350.
11,350.
So overall, we paid a total of 12,780. But the net asset was worth 11,350. Did we pay extra? Yes, we did. Because something that is worth 350, you pay 12,780 for it. So how much extra did you pay? 1430, right? So 1430. And this is what we call the consolidated goodwill at the acquisition date, because this is at the acquisition date. So we say goodwill at what? At the acquisition date. Okay. Then now, because this was at acquisition, we've gone 9 months. They said goodwill was impaired. Do you remember?
Yes.
So that impairment reduces the goodwill. So goodwill impairment, they said was 300. So this 300 reduces this. That's why it's an expense, right? So we take out that 300, and whatever we have is the consolidated goodwill. That's the goodwill at the reporting date or at the balance sheet date. So this gives us 1,1. Is it 1,130? Is it 1,130?
Yes.
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 So in that case, we go to where we have goodwill and say goodwill is 1,130 because it was 1,430 and there was impairment of 300, right? So goodwill is done. So we go back. Goodwill is done. Now, the next thing we need is our non-controlling interest. Please don't write NCI. In exam, just write your non-controlling interest. Remember, these people too have a share in the business, right? So those people too, you must give them their share of the growth. So you remember that this non-controlling interest, we had the fair value of NCI at the acquisition date. And the acquisition date, NCI's value was worth what? 2,500. That's what they invested. But you have to share the growth for them. So we say share of post-acquisition growth. How much was the post-acquisition growth? These guys had what? 20% of the subsidiary. So 20% of that growth. And the growth in the subsidiaries net asset was 1,650, right? So these guys will have a share in the 1,650, 20% of the 1,650. And that's 0.2 times 1,650. They'll have a share, and that is 330. For now, some of you who don't get it, just follow the mechanics. Yes, please.
Rio,
What's up?
on this.
Are we okay? So now we share the goodwill impairment as well. So everything you share for one investor, you must share for all of them. So the same way, we take 20% of the 300. Remember, 20% of the 300. which is a goodwill impairment. It's impairment, it's an expense, so it reduces it. So this NCI share, right? So this is what NCI has. So we have to close it off. There was nothing else that affected NCI again. That adjustment has already been done. So plus 330 minus 2 minus 60. So that's the value of NCI 2770. Okay. Now we come to the last working, which is our consolidated retained earnings or consolidated income surplus. So the same way we take all of the parent retained earnings. So the parent was HK. So all of HK's retained earnings. So you have to take what the parent already has. Then you see how much extra the subsidiary has given it. So we go and check what the parent retained earnings was. So the parent income surplus was 25,600. So we take the 25,600. And remember, there was an unrealized profit on inventory. Do you remember? Do you guys
Yes.
remember?
Yes.
Yes. When the parent sold to the subsidiary, that unrealized profit of what? It was how much? 500, right?
Yes.
Yeah, we have to take it out because we said debit seller's profit, reduce the seller's profit. This guy was a seller, so we reduce that profit. So now we take it out, then we share what? Share of post-acquisition growth. You see, whatever we did for NCI, we are doing same for the parent. So that post-acquisition growth of the 1650, the parent takes 80% off that 1650. And the same way we share the goodwill impairment. So share of goodwill impairment. You see, just like we shared the post-acquisition growth and goodwill impairment for the first investor who owned the 20%. This is the account of the investor who owns the 80%. So you do whatever you do for this guy, you do the same for this guy. So the same way we share the goodwill impairment in the subsidiary. So that one too, we take 80% of that 300 goodwill impairment. So 80% of the 1650, and that's 1320. And then 80% of 300, that is 240. So you take it out. Okay. Since there was nothing else that affected our retained earnings, that is it. So we have 25,600 minus 500 plus 1320 minus 240. And that is 26,180, 26,180. So now that we have this NCI being 2770 and 26,180, you go to the balance sheet and you say this one was what? 2770, and the retained earnings was 26,180, 26,180. So we are done with the balance sheet. So now you can close everything up. So this one, you can get your 10,000 plus 3,600 minus 750. So 12,850. So this one gives us 12,850. Okay. Then this one is 1,000. Already have it here as 1,000. Okay, good. Then that is it. And stated capital. Here they said, okay, during the year, HL paid dividend of 0.8 per share. SK did not pay any dividend during the year. Okay, this was the parent paying dividend. So literally, it doesn't have any effect because the parent's dividend is the parent's dividend. Don't let it confuse you. It's when the subsidiary pays dividend that we should be concerned. All right. So that is it. Okay. So NCI parent stated capital, there was no share exchange. So it's still 10,000. All right. So that is it. Good. Now let's come to the asset side and start putting them together. So 19,320 plus 8,000 plus 3,200 minus 600. You are the one supposed to be doing this computation for me. Me, I finished writing my exam. I told you already. So long ago. So 29,920. Okay, the next one is 0. Then current assets, that's 15,000 plus 8,000 minus 500 minus 750. That's 21,750. 21,750. Okay, so that is it. So in exam, mostly don't worry yourself balancing this off. Though I know it will balance, but in exam, don't worry yourself balancing it off. I'm here to also teach you exam technique. Okay, so once you are done with this, you are done with the balance sheet. You go to the P&L. So this was the only thing that affected the subsidiaries profit, right? So we can go in there and then you go and adjust it, right? So let's see. This is the subsidiaries adjusted profit after tax, right? With those profits. So the profit after tax was 2,250, right? Minus the 600 minus the 300. And that is 1,350. Okay. Then I come and add my OCI, other comprehensive income, to it. And when you look at the case, you can see that the OCI that we had only belonged to the parent. So it means that the subsidiary didn't have any OCI. Do you understand? So if the subsidiary has no OCI, you don't bring any OCI here. So it means that NCI share, because OCI will be 0, right? So OCI is 0. The subsidiary has no OCI. So this is still 1,350 as your total comprehensive income. So that means the NCI share of the OCI and the TCI and profit after tax is just the same. So NCI share of profit after tax will be what? 20% of the 1,350. Okay, this is how we do it. So we take 20% off the 1,350, and that's 270. And the TCI is still the same because OCI is 0. So NCI share of total comprehensive income is still the same 20% off the 1,350. Because here you share this, then you come and share this. But here was 0. If it was something, it will change this, right? So it's still 270. So on the face of the account, when I come down here, I'm going to say NCI share of the profit is 270. And NCI share here is also 270. So whatever I get now, I'm going to balance it with what is here. And then you are done. So let me close everything up. Revenue, what's my revenue? That's 60,000 plus 9 over 12 times 24,000 minus 12,000. That's 66,000 to be my revenue. Good. Cost of sales, 42,000 plus 9 on 12 times 20,000 plus 600 minus 12,000 plus 500. That's 46,100. So I bring my 46. Please, if you don't close the bracket, you haven't consolidated. If you don't close the bracket, you haven't consolidated. I'm telling you, in exam, don't forget. I'll keep repeating this till the time you write. So 6,000 plus 200 by 9 on 12 plus a 300 goodwill impairment. And that's 6,450. So 6,450 operating expense, take it out. Then we have interest, 75 minus 9 on 12 times 200. That's 75. Okay, so we now get our profit before tax. So 66,000 minus 46,100 minus 6,450 minus 75. That's 13,375, 13,375. Then we take out our income tax. That's 3,000 plus 9 on 12 times 600. And that's 3,450. So that is 3,450. Close it off. So we get our profit after tax. That's 13,375 minus this 3,450. That's 9,925. 9925. So other comprehensive income was still 1,000. We can see from there, and that's 10,925. So our profit after tax, which is attributable to the group, out of this 10,925, out of this 9,925, 270 is for NCI, right? So in that case, how much goes to the parent? So 9,925 minus 270, that is 9,655, right? 9,655 belongs to the group, right? Because that's the balancing figure. So that means you are taking what? The 9,925 here, and you are taking out the NCI's 270. So you are left with 9,655. And the same way, this one too sums up to our 10,925. If we subtract the 270 that belongs to NCI, it means you have 10,655. 10,655. Which means that we are taking the 10,925 and taking out our 270 that belongs to the NCI. So that is it. We are done with the question. So that was the very first session. I hope it wasn't a bad one. So the question will be shared right after the class.
And the workplace,
You said?
the worksheet too.
Yes, I'll share the worksheet. Don't worry.
Okay.
And the
But
video.
how was the session?
Yes, sir. Yes, sir.
Yes, boss.
Yes, sir.
Hey, I'm just very glad I didn't miss this session. I learned a
More
lot from it.
exciting sessions will be coming. This is just a tip of the iceberg.
Yes, I'm just excited that I learned, a lot from this.
Really? But today
Really,
we didn't
really,
do
really.
anything. No.
So some of the concepts you read them on your own, and then all that, and you still don't grasp them until
Okay.
solving a question
So,
makes everything looks easier.
okay, that's fine.
Hello,
The fact,
sir.
Yes, please.
Sir, please end the video.
The video will not be shared. The video will not be shared. You know why the video will not be shared?
Why?
If I will even share, I'll only share with people who join the class because.
Oh, what should we beg? Because that's the whole point, so that we can revise. So right now, if you are revising and you get stuck, I mean, sometimes accounting, you have the solution there, but you don't know where the figures are coming from. But with the video, when you are stuck somewhere, then at least you refer,
Do
please.
you know something about
Otherwise,
morning class? It wouldn't
is
be
it?
fair to share video for morning class. I only share with you guys on the call. Maybe. Because some people will sleep at their own comfort.
Okay. If that
Prof,
one
you
Enjoy.
there,
are right. Prof, you are right. You are
And
if
right.
that's the
enjoy.
condition, we are
Then
really to accept it.
those people who come and I've sacrificed my sleep. Then you will sacrifice your sleep and come and join. Then somebody knows video will be shared, so he won't join. And later will be
Ah,
requesting for video. No, it's not fair. So if you
if
miss,
that's
you
the
Prof,
miss.
condition, we
you
accept.
are right.
If
You
that's the
miss.
condition, we accept.
Yeah,
Only
so you
those
have to
who
be on
join.
the call. Yes.
Yeah. So share with it. Share it with those of us who are on the call. That condition, I think
So
it's
that means there must be a way to account for those who are actually on the call. Because
Exactly. Yes.
you wouldn't know. You see? Yes.
you will know. I mean, we are there.
We are there, but not everybody is using their full name. I don't know the numbers. Do you get it? So somebody should be able to recognize or share with someone so that I can know. Otherwise, session ashiegu.
So then
Sir,
maybe
please,
you make the
sir,
condition.
please.
Otherwise, revision will be very difficult for us.
It's not easy. But
Revision will
that
be
is one of
We are begging.
begging.
or you can make it a condition that everybody joins with their right official names.
Of course, you have to join with your full name. And even on your WhatsApp, some of you don't have your full names there. So it will make it kind of difficult. But anyway,
That's
this first video I will share for everyone to have
Thank you.
way.
okay.
It. It's already on my YouTube channel though. But subsequent meetings, no video. If you have to, if you want the video, then you pay a small fee for the video. I hope that sounds fair. Yeah. So
That would be fair. That would be fair.
yeah. So if you want the video, you pay a small amount for it.
In terms of how much, please?
Oh, very small, like 50 CDs or 30 CDs. I
Oh,
don't know.
okay.
Yeah.
Okay. Is
So
it for
that's-
each video?
Or per
Is
course?
it going to be any video you do or?
Yeah, any
like-
video. Yes, it will be for a small fee.
Oh, okay. Okay.
Yeah.
Okay.
So that it will be fair to everybody. So if you miss the session, then you pay for the video. So that those who joined will not pay. So how do I know those who joined? Is it like a secret password? Okay, I'll mention a password on the call now. If you joined, then you will mention the password to me. Unless you go and tell your friend. Then the password will give you a discount for the video. But those who didn't join, they'll pay the full amount. Do you get it? I think that sounds fair.
That's fine.
Yeah.
That's
Aha, so it's fair to everybody.
What about those of us who join with a full name? So that one is easily recognizable, right?
Yes, but I wouldn't know on WhatsApp. So this is fair. Let me just give you the password so that you pay a discounted fee for the video. That's
Okay.
how fair, right? But the others who pay full for the video is because see the number of people on the platform and see the number of people who joined the meeting. Me, my time is very precious to me. I was somehow happy with your turnout. I'm also disappointed because the number of people who are pressuring when are we starting class and they didn't even join. It's very disheartening. Anyway, I believe subsequent lectures there will be a lot of us. So today's video I will just share with everyone, but subsequent ones I will share a password for those on the call. So if you mistakenly drop, then you miss it. Okay. So how would I know those who joined today to get the video? Anyway, let me post it for everyone to have a look at it.
So, Prof,
Yes, boss.
I want to suggest something. Maybe during this session, like you can appoint a class rep who creates a WhatsApp page and drop on the Zoom platform. Then when you are done, you share the video with him and drops on that page. Within 2 hours, we take off that platform.
But that can also be a lot of work. So we'll go with our password approach. So those on the call have access to the password. So once you share the password with me, I know you were on the call. And then you can either get the video or you get a discounted price for the video. But the rest get the video. They pay for the video, a very small fee. I mean, it's something that you can close your eyes and pay. So, all right. But how was today's session? Was it okay?
Yes. Very educative. I mean,
it's very okay. But you see, since it's the first time, some of us having a grasp of the workings, we have to sit down and then
Yes,
go
that's why
right
you will watch the video. Yes, after you watch the video and you practice the same question about 2-3 times, you have a hang of it. Then you try solving other questions. So the video will come. Today's video will come. Yeah.
Exactly.
So that you can practice.
So,
So I'm
sir,
sure
please,
tomorrow too will be corporate reporting. I don't know. But let me check. If tomorrow is corporate reporting, then we will try another consolidation again. Are we okay? If it is management accounting, then tomorrow I believe we'll start with activity-based costing. So,
hello.
Yes,
sir.
hello.
So I have a question.
Yes, boss.
The corporate reporting, some are not writing a corporate reporting, they are doing FR. So I don't know if they should be joining both FR and
Yes, you have to join FR and corporate reporting. That's why if it is FR and corporate reporting, I'll tell you. This console we are doing is for both. If we get to advanced console, it's only corporate reporting people that will join. If you are doing something like ethics, both of you must join. If you are doing specialized accounts, only corporate reporting. There are some things that apply to both corporate reporting and FR. Okay. And I like it that way because you see, this question is a corporate reporting question. But you see, those doing FR, it gives you more insight. This question in FR is 20 marks. So imagine you can do this style of console. If you go to FR, you will never struggle because you have a good grasp of the concept. Do you understand?
So in a week, the FR, how many times are we meeting?
It depends. The timetable will come today, so you will know. So
Okay.
FR, you are meeting on Sunday. Okay, FR, you'll be meeting Sunday dawn, which will be a longer session, and then you will meet on Monday like this.
Okay.
So you will have 2 sessions. Yes. Then CR, you meet either tomorrow or I don't know the date, but I will confirm from the other tutors. Okay, so that we will know how we can blend it.
Very well.
But the sessions will be very exciting. I mean,
and so what's of the main classes, the timetable?
okay, the main class, I will share the timetable with you. Okay, today is strategic case study. I will start strategic case study at 6:30. And today we are going over last diet paper, like everything. I'll solve everything with you today. So 6:30, those doing strategic case study, we are live. Tomorrow is corporate reporting special. Okay, so have a nice
Hello,
and
Prof.
beautiful day. Yes, my boss.
So we are having a
Can
video
understand
today.
something there? Like, is there a
So
paid session
what's the
or
password?
No, today's own day, I will give it to you for the video will be given for free, no password. It's from tomorrow that I'll
Please,
start
on
giving
the
you.
WhatsApp or where?
You mean the video? Oh, the video is
Yeah.
on my YouTube. So just
Okay.
after the class, I will share it on the platform. So
Okay.
for you to have access, yes. But please, those who want to
Yeah,
sign up
Prof.
for the regular class, you can reach out to me or reach out to admin.
Okay. That's what I wanted to know. Okay, that's fine.
Yeah. And the regular class is very intensive. Like I will stress you to pass. Like you won't get breathing space at all. Mocks and questions and headaches. So if you like headache, you join regular class. So that you go and take our
Sir, please,
my
I wanted to know your fair assessment of last sitting FR.
Oh, it was very easy. But people don't learn. It was cool, but people don't learn. So I will teach you a strategy.
Reporting. Are you the one taking the regular class?
Together with one of my tutors.
Oh,
not
okay.
alone, yes. But I'm there for exam techniques and to help you pass. That's my job, right? So every course you are doing, you will definitely see me. I'll be there to help. My guys are top notch. They are top notch, like top notch. Yeah. So you don't have a problem. You are in good hands. I'm there to, add your touch-ups where you have your problems, how to, even if you don't know, how can you make the best out of the little you have? That's my style. Do you get it? Yeah. So you don't have a problem. So today I'm rolling with strategic case study, 6 p.m. Please, those who are interested in the regular class, kindly reach out to our administrator and let's take it from there. Good. Yeah, Thomas is the one teaching you corporate reporting in the regular class. So Emmanuel, you'll be seeing Thomas for regular class in corporate reporting, eh? He'll be taking you through the regular corporate reporting. And Thomas is good. Trust me. My guys are good. Very good. So you're in good hands. All right. May the Lord be with you. I'll see you. Have a beautiful day.
Same to you, Prof.
All right.
Thank you so much.
You're welcome.